my great pleasure to welcome you all to the London Investor Show. This is the 9th edition of the London Investor Show, and it's a great honour and a pleasure for Fidelity to sponsor this show. The show is all about empowering you to become better investors, to make better investment decisions, and to get better investment outcomes in the long run. And that very much ties in with Fidelity's mantra about making good investing easy. So we feel it's a really good fit for us to be here, and delighted to see so many of you. We've got a few speakers from Fidelity today. Obviously, I'm speaking for the next half an hour. Charlie Nickel, our retirement specialist, will be speaking later in this auditorium. My colleague Michael Curry has already spoken next door, and Alex Denny will be talking later about investment trusts as well. So a nice spread of topics and speakers from Fidelity. Right, okay. Let's kick off. I've got to show you this very important information. The first one, of course, apparently investments can go down as well as up. You may have noticed that in the last couple of weeks. I certainly did, but the rest we won't worry about. Okay. What I'd like to do today in the next half an hour is to give you some investment ideas, 9 to be precise. And along the way, I also want to answer a deceptively simple question. And the question here is, why do we invest anyway? I think sometimes it's useful just to get back to basics, because if you don't know where you're trying to get to, then you will almost certainly end up somewhere else. So I had to think about, what are the fundamental reasons that we invest? And I think they're all about these three elements that I've talked about in the introduction, and you will have seen in the blurb about today: growth, income, and capital preservation. So what do I mean by growth? Essentially, one of the reasons why we invest today is because we want to buy something tomorrow. And probably what we want to buy tomorrow is more expensive than we can afford today. So we need to exert some self-discipline, we need to put some money aside, and we need to tap into the remarkable ability of the stock market to generate growth for us. So it may be a car, it may be a wedding for our children, it may be a house. Whatever it is, we need to be disciplined, and we need to tap into the growth potential of the stock market. That's the first reason we invest. The second reason we invest is that, with the best will in the world, however much we enjoy our jobs, we probably don't want to do it forever. So at some point, we need to turn our capital, the capital that we've generated through growth, into an income, in order to stop working and enjoy life. Because for 99% of human existence, lives have been nasty, brutish, and short. Now, fortunately, they're not anymore, and the chances are we are going to live for quite a long time, and we're probably going to live for quite a long time in retirement. So generating an income from that capital is the second principal reason why we invest. And the third reason is that none of us wants to be a burden. We don't want to rely on our children to look after us, and frankly, we're not going to be able to rely on our children to look after us, because they're going to be too busy trying to buy a house and afford all the things which were quite simple for us to buy when we bought them, and are very difficult for them to buy. So capital preservation is an essential element in these three pillars of investment. And the last 2 weeks have underlined why capital preservation is even more important than maybe we thought, even as recently as a few weeks ago. So these are the three pillars that I want to talk about, and these are the three pillars against which I'm going to make some recommendations, some investment recommendations. So let's focus on growth first of all. And a key element of finding growth is being in the right part of the market. So following the growth, being where the growth is. What this chart shows is the performance of various stock markets around the world over the last 10 years. And you can see that it really does matter where you have invested. So if you've invested in the United States, your total returns would have been approximately twice what you would have got if you'd invested closer to home in either the UK or Europe. You'd have done a bit better if you'd invested in Japan or the Asia-Pacific region, but the United States has clearly led the way over the last 10 years. So being in the right place, terribly important. The second thing that matters is being in the right geography, yes, but being in the right sector. So the sectors which have done well recently, we know that technology has driven the market higher. There are parts of the technology market, the parts of which are growing extremely strongly. Healthcare is another part of the market which is growing well. And I think a very interesting area in the next year or two is actually going to be in the medical world. And I'm thinking specifically about medicinal cannabis. We've had these terribly sad stories this summer about the young children suffering from epilepsy and how cannabis has been able to help them. Just this week, we've had a relaxation of the rules about recreational use of cannabis in Canada. This is going to be a very interesting area. It's not an uncontroversial area, but I think it's going to be a very interesting area. As I say, we know that technology has driven the market. Apple became the first $1 trillion company. Netflix has doubled its share price in the first 9 months of this year. Interestingly, though, being in the right sector matters both on the way up and on the way down. Just in the last 2 weeks, we've seen how heavily the areas of the market which have performed best can come down as well. Technology has been the area of the market which has fallen most dramatically in the last couple of weeks. And then, of course, there are other areas which we don't even really know what the potential is going to be. So artificial intelligence, automated driverless cars, these are areas which are all going to be very exciting. So right geography, right sector. And then, of course, it's all about picking the right stocks. I like to show this stock because this is a way that I can be a little bit self-deprecating and show you something which I failed to do and which I should have done. The company I'm talking about here is Fever-Tree. Now, how many people here like a gin and tonic? One or two. How many people here prefer the sickly sweet Schweppes tonic in their gin to the Fever-Tree tonic? Not many, exactly. Now, I realised that because I loved the Fever-Tree tonic. I was a buyer of the Fever-Tree tonic. It was obvious to me that it was a better tonic. It was obvious to me that this was a growth market. Did I buy the shares? No, I didn't. Am I furious with myself? Yes, I am. Fever-Tree shares have risen 20-fold from their flotation a few years ago, 20-fold. Now, actually, this is a slightly old chart, I must confess. They've actually come back about 20% since this chart was drawn, but nonetheless, it shows that if you're in the right geography, if you're in the right sector, and you're picking the right stocks, then there is enormous growth potential. But growth is just part of the story. What matters as much about the growth story is the price that you pay for that growth story. This chart shows the ratio of share prices to corporate earnings in Japan. It's a very interesting story here because quite often there's a mismatch between growth and the price that you pay. The Japanese stock market has performed very badly this year, and the reason why it's performed badly is largely to do with these trade tensions that have been stoked by President Trump. Japan obviously is an economy which is very dependent on exports and on global trade. It's performed badly, but the earnings of its companies have actually done pretty well this year. So what we've seen is a declining market and earnings continuing to rise. That means that the valuation of the Japanese market has got progressively cheaper. This is a chart that I really like to see. So find the growth and then look for the growth at the most attractive price. Japan is a very interesting situation at the moment. Just one more point I want to make about growth before moving on to income, and that is that growth does not go on forever. Growth in stock markets does not go on forever. Bull markets continue, but they do not continue forever. And what we've seen, what this chart shows, is that the bull market that we've experienced since the financial crisis is now arguably the longest in post-war history. It's overtaken the bull market in the 1990s that led up to the dot-com bubble. It's longer than the previous bull markets in the post-war period. So the big question now is, are we getting towards the end of this bull market? There is a saying that bull markets don't die of old age, they're killed by the Fed, and that's the key question at the moment. What is the Federal Reserve doing with interest rates? How quickly is it going to tighten policy in the United States, and is that going to be enough to stem the growth in the stock market? I think the duration of the stock market by itself is not a reason to worry. I'm not concerned that the market has been rising for 10 years, and the reason why I'm not concerned is that actually, although this looks like the longest stock market, I think you can make a strong argument that the 1990s stock market was actually just half of a much longer bull market that lasted from about 1982 to about 2000. I think it was an 18-year bull market. And so the fact that we've had 9 years of rising markets by itself doesn't worry me. What matters more is, can the earnings continue? What is the valuation that's being attached to those earnings? And is there anywhere better to put your money? Well, as for earnings growth, I think what we're seeing at the moment is earnings growth is still strong, thanks to the tax cuts in America. It's not probably sustainable, though. We've got 20% earnings growth at the moment. It's probably going to be 10% next year. How's the market going to cope with that? Remains to be seen. In terms of valuations, because earnings have grown so strongly, I think that valuations actually are not that demanding. They're not too stretched at the moment, so I'm not too fussed about valuations. What about the alternatives? What are the alternatives to shares? Cash and bonds? Well, as interest rates rise, as bond yields rise, the alternatives do become relatively more attractive. So I think, yes, we are moving towards the end of this bull market, but I do think that it's too early to call the end of it just yet. So, in terms of growth, if I'm right, and if we still have got some growth left in this market, where would I be looking? Well, all three of these funds appear on the Select 50. The Select 50 is our list of preferred funds. If you'd like to find out more about it, then please do go to our stand outside here, literally just outside. And you can talk to any of my colleagues. They'll talk to you about the Select 50. These are funds which we really have strong conviction in. They're the funds that we believe are the best in the market. And all three of these appear on the Select 50 list. UK, Japan, global. I met up with James Thompson, who runs the Rathbone Fund, earlier this week. And it was an interesting conversation with James. He was quite bruised. He's had a really tough 2 weeks. This is a fund which has had a fantastic track record over time. Over the last couple of weeks, it's lost about 10% of its value. That's a really difficult position for a fund manager to be in. But what he said to me, which was really interesting, was he said, I am finding more opportunities at the moment than I can remember. There is plenty of growth out there. And he's a really good manager, and he finds that growth. So that's an interesting opportunity. I mentioned Japan. I think Japan is a market which is growing well. I think they've largely defeated the deflation which has haunted the market for so long. They are beginning to boost their workforce by encouraging immigration, getting more women back into the market, and the market is quite cheap. So I think Japan is quite interesting, and the Baillie Gifford Fund is a very good fund, extremely well managed, and it's got a real focus on one of Japan's competitive advantages, which is its position in automation. They're very good on stocks which play the automation game. Nick Train, very good long-term record again. Very concentrated fund, so it's not without risk. He has about 25 stocks in his fund. Again, he's had a bit of a pullback in the last 2 weeks, not surprising, but he's a very accomplished manager. So those are my growth picks for today. Now let's move on to the second pillar of investment, income. Now, I told you about the returns that £10,000 would have given you in the stock market over the last 10 years, £40,000 in the US, £20,000 in the UK, maybe £30,000 in Japan and Asia. This is what you would have got if you'd stuck your money in the bank. The princely sum of about 150 quid. So clearly, income has evaporated over the last 10 years in the cash market. Cash has been a really bad place to be in terms of capital growth. We know that. Where else do people look for income? Traditionally, they look in the bond market. The bond market has also been a very poor place to find income. As interest rates have come down, the yields on bonds have come down with them. Now, we're beginning to see a bit of a watershed here. We're beginning to see a change. But you look at this chart, and it's quite difficult to see it really. Bond yields remain low. They may be rising in the US a bit. They're just above 3% now. But you look at the UK, you look at Germany, you look at Japan, frankly, you might as well leave your money under the futon because it's not going to earn anything in the fixed income market either. What about property? Property is traditionally an area where people have gone for income. The commercial property market, it's been a source of inflation-protected, reliable, dependable income. Well, what's happened is so much money has poured into the commercial property market all over the world that in the prime areas, I'm talking about London, places like Munich, Paris, New York, Tokyo, in those areas, the commercial property market has got very hot indeed. Indeed, the yields that you can get on commercial properties in some places, in some of those hottest markets, down to about 2.5%. 2.5%. That's a 40-year payback. I wouldn't want to buy a share on 40 times earnings. And property, I think, is even worse. Why? Because when you think about an asset like a commercial property, it declines in value over time. Obsolescence, depreciation, it all chips away at the value of the property. It's estimated that that accounts for maybe 2% a year. Property is also a very illiquid market, and so investors should be receiving a reward for that illiquidity. So factor in depreciation, obsolescence, and the premium for illiquidity. Basically, people are investing in property for no return at all. Makes no sense, completely unsustainable, I think. Now, why does income matter? Obviously, income matters in itself. When you have reached a stage of life where you want to turn your capital into an income, obviously the level of income matters. But income also matters because income is the primary driver of total returns in most investments. So the value of a property, the value of a share goes up and down. But the income, hopefully, keeps delivering year after year after year, and thanks to the magic of compounding, it rolls up and it becomes the largest contributor to total returns. Income is really important from a capital perspective as well. And this chart shows how the level of income, the amount of income, or the amount of total return also matters. So if you put £1,000 into an investment and you grow it at 5% a year, then after 20 years, you'll end up with £2,500. If you put it in at 10% a year, then you're talking about £6,500. If you put it in at 15% a year, then you're talking about £16,500. So the jaws widen like that. So getting a decent income, getting a high and sustainable income is really important if you're also interested in capital growth. Income, though, is a tricky business because sometimes income can look attractive, but it just isn't. It's a trap. It's called a value trap. Sometimes when an income is too high, there's a reason for that. A really good example of this was BP a few years ago. Before BP had its spill in the Gulf of Mexico, it was yielding, apparently it was yielding a very high yield. The reality was that yield was not covered by earnings per share. It was not protected by earnings per share. So as soon as BP had a problem, as soon as their earnings fell because they had the issue in the Gulf of Mexico, the dividend was no longer protected, and it went. It's the first thing to go with a company. So dividend cover is really important, and when you're looking at income, when you're chasing income, or when you are getting a fund manager to chase income for you, really important that you look at the sustainability of the income, not just the level. Okay, so when it comes to income funds, I've given you the 3 growth funds. Now when it comes to income, 2 of these, the top and the bottom, again, on our Select 50 list. Invesco have a really good equity income franchise, actually. Stephanie Butcher here, who runs the European Income Fund, this is a really good fund. Her boss, the Chief Investment Officer at Invesco Perpetual, a guy called Nick Musto, he runs a global investment equity income fund. That's also a very good fund. So if you're looking for equity income, that's a good place to go. Jockham, also James Lowen here and his partner Clive Beagles, they run a very strong sort of mainstream equity income fund at J.O. Hambro, otherwise known as Jockham. And then at Fidelity, we have a really excellent multi-asset income fund. This is run by a guy called Eugene Philalethis, really excellent manager. And one of the reasons why he's excellent is because he really focuses on the defensiveness of his portfolio. So I was having a look at the performance recently, just in the light of the falls that we've had. This fund has been a really smooth performer, and that's partly because he's a very cautious manager, but partly because he benefits from this multi-asset spread of investments across equities, across bonds, across infrastructure, all sorts of different sources of income. So that's 2 pillars, growth and income. Now I want to talk just quickly about the 3rd pillar, which is capital preservation, which of course is so important at the moment as markets become more volatile. Now why is capital preservation so important? Well, the key reason why it's important is because without capital, you can't have growth, and without capital, you can't have income. If you don't sustain your capital, then you've got nothing to grow, and you've got nothing from which to generate an income. So this is why this guy, the best investor of all, says never lose money, and don't forget, never lose money. So capital preservation, terribly, terribly important. So how do you preserve your capital? Well, here's a very simple way of preserving your capital. I talked about Eugene's multi-asset income fund and how he benefits from diversification. What this chart shows, very complicated chart, don't worry about the detail. All it shows is that each cell here represents the performance in any given year, vertical lines, in any given year of an individual asset class. So we might have global equities, for example, up here. We might have commodities down here. Okay, so what you can see is that in any given year, there's a huge variation in performance of different asset classes, different geographies. So the best way to ensure that you're not in the wrong place is to make sure you're in lots of different places. Make sure your eggs are in lots of different baskets. A couple of other points I'd make about this chart is, yes, there are different performances, but also it's totally unpredictable. You just don't know from year to year which is going to be the winner and which is going to be the loser. So emerging market equities, top in 2017. Emerging market equities in 2018, right down the bottom. There's no way ahead of time of really knowing which is going to be which, and that is why we need to keep a spread of investments. The second point that I would make about this chart is that there isn't a single year, this is 10 years, there isn't a single year in the last 20 years when we've looked at these figures when all the asset classes have fallen in tandem. It just doesn't happen. Sometimes they all go up, sometimes some go up, some go down. It just doesn't happen that they all fall. Famous last words. Right, I just want to talk briefly about this chart because this is a really, really interesting chart, and it's a really interesting chart, I suspect, to many people in this room. Let me just explain it. The 2 lines here represent the experience of 2 different investors. They're both in retirement. So let's say that this is age 60, and let's say that's age 92 over there. This is the experience that they experienced during their retirement. They start off with a pot of money, So it says 150,000 here. It doesn't really matter what the number is. It doesn't really matter whether it's pounds or dollars or whatever. They start with a pot of money. Every year they take some money out. They take an income from their money, which is what we've been talking about, generating an income. And they replenish that income with growth in the value of their investments. Probably they don't replenish it with putting more money in. They're retired. They're not earning anymore. Okay? So the growth that they get has to replace the income they take out. Now, what's the difference between these two lines? The two investors here experience exactly the same returns every year during that 32-year period. The difference is that they're reversed. So the dark blue line has a few good years, and then he has a few bad years, or she. The light blue line is exact reverse. He has the bad years first, and then he has the good years at the end. The trouble is, the sequence of your returns really matters. If you have your bad years first, and you're taking money out, it's a really bad combination. And this poor person runs out of money after 22 years. They run out of money in their early 80s. That's a really bad situation to be in. So this is why capital preservation is so important. You need to ensure in those early years that you're holding on to your money. Right, here's one way to ensure that, that you do hold on to your money. What I've got here is a chart which shows the actual returns from different buckets of shares. And I've bucketed the shares according to their valuation. So over here, we've got the cheapest shares at the beginning of a 10-year period. And up here is the return that those shares generated over that 10-year period. Over here, these are the most expensive shares, and this is the return. And as you can see, it's a straight line. Basically, if you buy cheap, you stand a much better chance of getting a decent return. If you buy expensive, then you stand a really good chance of having a poor return. So the price you pay at the outset is the most important determinant of your overall returns. So it's really important when you're thinking about capital preservation that you're thinking about the price that you pay for your investments. And that's particularly pertinent at a time like now when the market has been going up for some time. So capital preservation, here are the last 3 of my 9 recommendations. So there are lots of bond funds which can offer quite a smooth ride. Some of them are strategic bond funds. Fidelity has one, Jupiter has one. They're both on the Select 50 list. This M&G fund is also on the Select 50 list. It's basically a bond fund. But the reason I've put it here is it has the option of investing in equities as well if the manager sees that as being the best source of income for that particular asset. So that's quite a flexible fund, and I think flexibility is really important. Flexibility is absolutely the hallmark of this second fund, which is a new fund. We launched it in February. It's called the Fidelity Select 50 Balance Fund. It's a fund which uses our Select 50 as its starting universe, and it invests in a balanced way across that. So it has approximately 60% in equities, approximately 40% in bonds. It varies a little bit around that, but it's basically a balanced equity and bond fund. Aisha Akbar, really nice manager, really, really competent manager, and she's doing an excellent job so far with that fund. The final thing, what a boring recommendation, but you know what? It's really nice to have a bit of cash in your back pocket when the market is volatile. The market has fallen by 10%. The last thing you want to be is completely invested. You can't do anything about it. You've got some money in your back pocket, then you can dip in and take advantage of these movements, and you absolutely need to do that. So it's been a real pleasure to speak to you. Thank you very much for listening to me. Thank you for coming to the London Investor Show, and please do visit the Fidelity stand, find out about the Select 50, find out about my investment outlook, which comes out every quarter, find out about our wealth service and how they can help you. Thank you very much indeed.